Welcome to The Way to Build Wealth. I'm Ethan Bloch, and I'm helping you build some wealth. Welcome to the show. It's Friday. I got the jacket on. I'm pumped up for Fancy Friday. And if you're like, hey, Ethan, I've seen that jacket before, don't worry about that. Let's get right into the show for today, talking about money market funds. I mentioned them yesterday when we were talking about savings accounts. So today I'm going to get into them, shine a little color on what they are, how to use them. I think they're great investment vehicles for saving money. Difference is saving money means you're saving it for something down the road, a vacation, a car purchase, a house down payment, something that you can foresee, in the near future, whether that's 24 months, 12 months, 18 months, what have you. Investing, however, is different. You're socking that money away for the long term to build some wealth, but we can save money and help build some wealth at the same time through money market funds, potentially. So money market funds, they basically are, what are they? They basically invest in an array of different assets to preserve your money and give you some interest on top of it. Now there's two main money market funds, two buckets they all fall in. That's taxable money market funds and non-taxable money market funds. A taxable money market fund will invest your money in commercial paper, investment grade commercial paper, will invest your money in CDs issued by banks and financial institutions. And because they're pulling together so much money, they get a better rate on their CD and better terms than you and me ever could in our own right, going to a bank and saying, yo, give me a CD. On top of that, they also invest in treasury and agency debt or federal government debt, bonds, T-bills, agency debt from, Fannie and Freddie Mac, which as of recent, over the past couple of months, you might have heard caused some money market funds to have problems. But you got me, Ethan Bloch, looking out for you. Don't have shoulder pads today. And out of the whole world of money market funds and all the offerings, I've pulled out some gems offered by a couple of the brokerages we've already talked about on the show. Let me just recap. We've talked about Charles Schwab previously. We've talked about Vanguard. We talked about Fidelity. Schwab doesn't make the cut today, severing that off. They don't offer that many good money market funds at Schwab, and in my opinion, they charge too much on the expense ratios, and the yields they give are terrible. How about that? However, Vanguard and Fidelity in their own rights, yes, own right, offer some of the best money market funds in the world. A lot of advantages to their funds, one of which is not only are money market funds liquid, meaning you put money in, you can take money out. Out of Vanguard's and Fidelity's money market funds, you can actually write checks out of a lot of their money market funds. So then you really can substitute it as your checking account and your savings account all in one and work with a great financial institution like Fidelity or Vanguard. That's a win-win all around in my mind. Again, they both offer taxable and non-taxable money market funds. I didn't talk about what non-taxable money market funds invest in. Let's talk about that right now real quick. Non-taxable money market funds, this is simple pretty much, invest primarily in the debt of local, city, and state governments. Another word for that is municipal debt, which we briefly talked about in our bond talk days back. If you want to get into municipal debt and you're a new investor, this is the best way to do it. Super simple. Own the money market fund. Put money in the money market fund, and that's it. You're in that game. That being said, depending on what your yearly income is, there's not a huge advantage to owning the tax-free money market funds versus the taxable money market funds, because the tax-free money market funds have a lower yield due to the fact that they're tax-free. If you make $150,000 or more and you're in the upper, tax bracket, it's highly advantageous to do that because the money that you'll save in taxes is more than the money you would have gotten if you were invested in the taxable money market fund minus taxes. Does that make sense? I think so, somewhat. So that's that. However, for diversification purposes, we talked about that last week. Link it up down there. Diversification. It's not bad to still, if you can, have some money in a municipal money market fund. The final thing I'll say about their funds are The minimum initial investment to get into Fidelity's money market funds is $2,500, and for Vanguard's about $3,000. It is what it is. So if you're saving or you have savings, keep saving it up to the point where you can open one of those accounts up. They're really beneficial, just great all-around accounts from great companies. I'm probably plugging them a bit too much, but it's what I personally feel, right? It's coming straight from the heart. Anyway, there was one more thing I wanted to say. Trying to remember about the money market funds just a second ago. I can't think of it now. Oh, of course. How could I ever forget this? I made some sheets, linked them up down there for you. I love these sheets. You know how I feel about them. Breaks down the different taxable and non-taxable money market fund offerings from Vanguard and Fidelity. I'm not going to mention it. It's in the sheet. Tim was saying Prime, which is basically a money market fund offered by Vanguard that, in a lot of people's opinions, probably is the best taxable money market fund there is. They have a great track record, and it's very simple and easy to understand their strategy. That's it. Wow, I was going to say welcome. Thanks for tuning in. The cold I still have, I'm trying to get over it. Still going straight to my head. So I'm going to let you guys go for now. I'm Ethan Bloch, and I'm helping you build some wealth. Have a great weekend.